Last week ended with the news that aroused fear in the financial world. The key concern was the looming threat of the US government shutdown, which intensified risk of sentiments. This, in turn, may serve as a clear signal for the market to buy one of the most popular safe haven assets, the US dollar. For the second month in a row, the US dollar has shown remarkable growth. The US dollar index, which gauges the dollar's performance against the basket of 6 other major currencies, closed last week above the 106 level and even attempted to breach the threshold of 107 points. The demand for the American currency is bolstered by growing hopes that the US economy can withstand higher interest rates better than other economies. These expectations were further fueled by recent macroeconomic data showing that the US economy maintained a robust growth pace of 2.1% in the second quarter of this year. Meanwhile, the euro is gradually inching closer to parity with the US dollar. Investors are pricing in possible changes in the interest rate policy of the European Central Bank, or rather, they believe that the rates will not be raised further. The recent inflation data recorded a sharp deceleration in the consumer price growth, raising speculations that interest rates may be lowered as early as the first quarter of the coming year. The Bank of England has already opted against raising interest rates. At its most recent meeting, the regulator decided to leave rates unchanged, and this decision has naturally triggered a sell-off in the pound sterling, with the pound-dollar pair plummeting to its 6-month low. However, by the end of last week, the British currency attempted to stage a recovery, following encouraging news that the UK economy continues to maintain its growth momentum, avoiding a predicted recession. In the course of the previous week, the Japanese yen was aiming to break below its 11-month low at 149 against the US dollar. The Bank of Japan sticks to its dovish stance and keeps the rate in the negative zone, despite other major central banks adopting a more aggressive approach. Naturally, the yen is losing ground under such conditions, thereby encouraging monetary authorities to make verbal interventions, and the dollar-yen pair is approaching the key level of 150, a threshold that prompted the Japanese regulator to intervene in the currency market last year. In the meantime, gold is depreciating at a much faster pace. The price of the precious metal slipped below $1,850 per troy ounce, hitting its lowest level since March 10. Gold is losing value under the pressure from a stronger US dollar and rising bond yields that advanced on expectations that the Federal Reserve will keep its monetary policy tight for an extended period. In the oil market, traders failed to maintain the bullish momentum. As a result, oil closed the week down by 1.6%. Yet, after a sharp rise the day before, a correction was imminent as the instrument was strongly overbought. Investors are currently focused on possible supply shifts ahead of the OPEC Plus meeting on Wednesday. However, analysts doubt that the alliance will introduce any changes this week, as the previous supply cuts have already provided some support to the oil market. Global crude prices went higher by 7% in September and by 23% in the third quarter of this year. The main reason behind this rally was the agreement by Saudi Arabia and Russia to maintain the output cuts for an extended period of time. So, you have watched a combined review on a currency and commodity markets on the InstaForex TV channel. Subscribe to the channel and follow news with us. See you soon!